And I wanted to approach today's topic from the aspect of financial strategy and why it matters. If you do look at the right side of our slide, you will see that we've had a couple of headlines in the market where we've seen big businesses come under financial distress, properties being advertised, and some of the businesses that we thought were actually strong actually end up being insolvent and unable to continue in the long run. And this asks the question of whether, as we set up our businesses, we do have a financial strategy in mind and why it is important. If we look at some of the statistics that we do have in our market, we do see that the average survival rate of most SME businesses is about 4.85 years. And of these, only 46% actually do survive beyond 5 years. And even after 5 years, we see that 30% of those that survive actually don't make it even to their third year anniversary. And also we've seen that actually some of them don't even get onto their second generation in terms of the founder. So that begs the question to ask, and I mean, there can be several factors that do contribute to why some of these businesses do not survive. But the underlying string that is woven across most of the business is actually financial management. Now, what do we plan to achieve? And I hope I'll be able to deliver and do justice to this in this presentation today, is for us to understand financial strategy in terms of its definition and what it covers, to identify what are the key building blocks or components of a financial strategy, what's the role of a financial or strategic finance leader? We call them CFOs in most of the markets. And then how can we even access these CFO advisory services? Because I know for some of us, because we think our businesses are small and therefore we may not have the budgets, or we feel that these people are too big to actually advise some of our businesses. And we'll try to demystify this as we move ahead. So when we look at financial strategy and what it is it's basically a plan. It's a plan that a business has in order to survive for the longer term. In terms of how they set up their finances in order to manage money, resources, and achieve their long-term strategic goals or business goals. And so what this strategic plan basically does is provide guidance, especially when it comes to how are we going to allocate these resources, whether they are adequate in supply or they are minimal. How are we then going to integrate our funding? What sort of funding are we going to apply? Are we going to use equity? Are we going to use debt? Where are we going to deploy these resources? Are we going to buy equipment? Are we going to buy land? Are we going to invest in people as resources? How are we going to manage risk? And I know, Anita, you did talk about risk. We all know that we've seen the COVID pandemic come through. And of late, actually, we've seen the impact of the tariffs with the change in leadership in the US. And that is starting to trickle in across different businesses. And it affects how we do business in terms of cost. And so how are we ready for such events when they do occur? And then also, how do we plan effectively to ensure that we get the maximum value from these resources? The other is also the aspect of differentiating between what we call day-to-day accounting or operational finance, and then clearly planning strategically how your finances of the businesses should be run. I do know that most times we do feel that once we have an accountant, we are good to go, and therefore the numbers, we are able to look at the numbers and how we are performing. But who is able to challenge those numbers? Who is able to check that actually we are still on the same track of achieving our overall goal that we set to? Who is there to check that the finances that we have are being effectively deployed in spaces that will give value to the business? And then the other, we all know that we start entrepreneurship or we start businesses so that we can derive value from them, so that we can benefit. And therefore, there is need to focus on creating value from the business in terms of return to the shareholders, in terms of creating good customer service for your customers, but also the impact that you would want to have to the society in which you drive your business. Someone once said that investing is a journey of self-discovery. And so once money is given to you, then it sort of reveals your relationship with money. How comfortable are you with risk in terms of your risk tolerance? And how are you able to remain disciplined, even in circumstances where you have itchy hands to divert resources? How are you able to remain disciplined to ensure that you see out and achieve your goals in the long term, especially when you're facing uncertainty? Now, when we look at the core pillars of financial strategy, as a business, you look at your capital structure. And capital structure is basically saying, how am I starting this business? Or how am I going to fund the operations of this business? Am I going to pick resources of savings or capital or money that have been able to source from different people for businesses? They could be venture capitalists, they could be private equity funds, you could have angel investors, and the story goes on and forth. Or am I going to reach out to funders? And this can be banks, this can be development institutions, to see that you have an optimal capital structure. And then the question that is raised there is, how am I able to balance between debt or equity financing? And what are the benefits of debt? What are the benefits of equity? And why is it important to balance the two? The second is the aspect of budgeting and forecasting. Now, budgeting is actually a tool that helps you achieve your strategic objectives. It provides guidance. It creates guardrails within which your resources are meant to be managed. And then the other aspect is to also forecast, to say, I know we're in the last quarter of the year, for those whose financial year starts from January to December, and is to ask ourselves, how am I going to end the year? How am I performing in terms of top line sales? How am I performing in terms of expenses? How am I performing, and how would the business look like if I close the year, and what interventions do I need to do? And therefore, planning for this is very important. The other, we all know that we've talked about cash flow, and cash flow being king, and we evidently saw this during the COVID pandemic, that those businesses that were able to stay liquid or have cash available to use in either day-to-day operations or manage and mitigate any potential risk that would arise are the ones that remain float. And therefore, one of the key pillars, again, in strategy relating to finance is cash flow. The other is risk management. We all know that the environment in which we operate has inherent challenges in there, be it fluctuation in foreign currency, be it political risk. We know we are all in a time of election, and therefore pockets of instabilities could arise here and there. We know that there can be aspects around change in regulation and all. And therefore, identifying and creating interventions to mitigate some of these challenges is very important. And the last one is investment decision. So once we have capital available, how do we decide in terms of where to invest it, where we'll be able to receive an optimal return? So all these are pillars that are important, that need to come to the attention of any entrepreneur, any business, to ensure that they do actually meet their business goals in the medium term and the long term. Now, when we talk of capital structure, and just to delve a bit deeper here, I did talk about the balance. And why is this balance important? This balance is important from an aspect of people outside looking in, looking at how you're able to leverage your business to achieve your goals. Again, if the debt is too high, then your cost of funding will also be too high, and therefore you may not be able to achieve your objectives. Secondly, also, if the equity is also high, that means you've utilized a lot of resources to run a business, probably that may not give you an immediate return in the medium to long term. And why is it important to balance the two? Now, equity is important because most times equity investors do actually give you capital for a long time, and at a cheaper cost. Or these are funds that you, as an entrepreneur, have set aside that you're injecting in the business, knowing that you're going to achieve a return in the long time. However, also, debt is also important. And why is debt important? Because it provides leverage, because sometimes you may not have sufficient funds um, to meet the current business objectives, or you require flexibility in terms of accessing these funds so that you're able to address short-term or medium-term demands of the business. And this is the likes of working capital and revolving facilities that are made available to us. Now, capital structure is very important, especially for those who have businesses where they either plan to attract additional investors, or who are planning to either list them on the exchange, or who plan to bring in partners to help them navigate the next growth in their businesses. And it comes in the aspect around valuation. And again, managing or, or balancing your debt to equity ratio is important. We've seen businesses with debt to equity ratios in the north of 60 to 70%, and we've seen those as low as 30 to 40%. And in the eyes of an investor or someone planning to invest in you, the balance of this is important, because they are seeing how effective are you actually utilizing these resources effectively, so that you're able to deliver on the overall business objectives. So it's very, very important, because it actually maximizes shareholder value. Then the other aspect of this also is your cost of funding. I have seen businesses where they do attract debt, but they do not have the information or knowledge to understand that they can actually get this debt at a cheaper cost, or actually are able to leverage their assets, be it cash that is running on their accounts, to actually get better pricing for some of these facilities that they do obtain. And again, and we'll see later why, again, now you need a strategic finance leader to advise on some of these issues. The next bit is about budgeting. And I did talk about the fact that budgeting is actually a very important tool in terms of you achieving your overall strategic objectives. And why? So budgeting actually creates a roadmap in terms of how are you going to achieve your objectives by optimizing the existing resources that you have or that you hope to get. How are you going to manage performance of your business, be it monthly, be it daily, be it quarterly, ensuring that it's still within those particular targets that you set, and also ensuring that the business is sustainable in the long run. And we've seen that there are various types of budgets that exist. We have those that are operational in nature, that basically look at the day-to-day running of the business. We do have budgets that also speak to assets that you want to acquire that will help you either grow your business or run your business more effectively in terms of capital budgets, and then also cash budgets in terms of the resources that are available and how you're going to distribute these resources to make them more effective or give you a good return. And there are different approaches to budgeting. We have seen people who just have a performance of the previous period and then either add 3-4% depending on what they see the operating environment looks like from a macroeconomic environment. We have seen businesses which build budgets from scratch, especially those that really want to manage their costs effectively, or whose businesses are not really predictable and therefore do operate between seasonal horizons. So creating a zero-based budget then makes it more palatable to the nature of business that you're running or the seasonality of your business. And then those that are flexible, which is which is a commonality among either startups or entrepreneurs, because you do see your budget changing week in, week out because of the nature of the business that you're running, that structures have not yet been firmed up very well. And therefore, you need that flexibility to ensure that the business continues in a going concern way. Now, again, the benefits of budgeting are, one, you have control. Control is important because, again, you don't want to spend over and above what you have planned or what the business has or what the business can accommodate. But also, secondly, is also to manage and track some of the key things that you laid out to achieve, be it income, sales, how are you performing against what you had set out, in terms of the assumptions that you had used when setting up the budget, in terms of the number of products that you would sell or the number of services that you'll be able to deliver within a particular period of time. Are you actually achieving this? So it helps also in terms of tracking how your business is actually performing. Then some of the key things that we use in budgeting, and which is important, is at any one time is to do what you call your variance analysis. It's a very good tool, which basically shows you how you're doing against the target that you set, what are the insights that you're picking from this, and then how are you able to forecast based on what you've seen happen in terms of the business performing in the medium term to long term. Another pillar when it comes to financial strategy is cash flow management. We all know that cash is king for now. I do know many of the businesses do track profits. I'll give you an example. I've worked in the airline industry, and I do know many of you have seen, the performance of Uganda Airlines. And it's not unique really, because again, across the aviation sector, we do see that most of these businesses are actually loss-making. But where is the focus mainly when it comes to these businesses? It's actually on cash. You need to ensure that there's cash available to run your businesses or to run your day-to-day operations. You need to ensure that there's cash available to invest in assets or in equipment that will give you better efficiencies or that will meet that particular customer need. You need to ensure that you're able to access funding cheaply to ensure that your business stays afloat. And that's why cash flow management is very, very important. It helps ensure that your business is stable in the medium term to the long term. It helps ensure that you sustain your operations and also that you're able to seize opportunities. For those that are either in trade or that do provide services to different either government agencies or private companies, you will note that at some point either they'll ask you either to present your financials or to obtain guarantees from banks and all. And one of the key things that either banks look at or some of these entities review is actually your cash flow statement and whether you're liquid enough to actually either perform the service or actually deliver on the goods that are available. So it's actually very, very important. Now, cash flow management is good because you need it to track and forecast what money is coming into your business and what money is going out. You don't find yourself in a position where there's more money going out and yet there's little money coming in. Now, from a financial statement perspective, your performance in terms of your profit and loss, it might show that you're positive, but then you don't have cash to pay customers, you don't have cash to pay salaries, you don't have cash to pay suppliers, and therefore you'll find that your actual business becomes distressed as a result of that. And therefore, it's very, very important that you manage the inflows and outflows to sustain your business. And there are various strategies that can be applied when it comes to cash flow management. One of them is around invoicing. We have seen, and it's not so popular, though I'm starting to see it in the market in Uganda, what we call factoring in this market, where you do have an invoice, you've provided a service or you've provided a good, and then you're able to provide that invoice to a bank for them to extend working capital lines to you so that then you can use those working capital lines to operationalize your business as you wait for the person you've given the good to pay you. So that's one of the ways. The other is to negotiate with your suppliers to obtain good credit terms. Because again, sometimes suppliers deliver, and again, depending on the stability of your business, might either want you to pay cash up front, or if your business is actually good and seems to be trajecting in the right turn, you could be able to get favorable credit terms in terms of extending the time or period for which you need to pay. What that helps is that it gives you a bit of breathing room to actually to attend to any urgent payments or requirements of the business that are more important and urgent compared to you actually paying out that cash so that you're able to leverage to access small business opportunities as the suppliers wait to pay you. For those that are in the consumer products business, your inventory levels in terms of products you're holding, say if you're selling juice, or if you're selling computers or hardware items, how much of those are you stocking? Because remember, for every item that is seated in your store, that is actually cash because you've not yet converted it into a sale. So it's actually cash seated there. So are you holding optimal levels in your storage so that these optimal levels do not hold cash then that you can use to operationalize your business? So cash flow management is very key when it comes to financial strategy. And it's important that you always have your eye to it because it actually helps keep many businesses afloat. Then we come to profitability and cost control. And again, we know people who run businesses and they do not know whether the business is making money or actually the business is not making money. And also, how do we manage costs? Are we cutting ourselves to the bone to the extent that we are not able to survive? Or we are managing costs in a strategic way that first of all creates room to focus in areas that will give you more value, that is able to safeguard the profits or margins that you're making per product or per service, but also that's able to give you a platform for growth, especially in extending your business to grow in the long term. And therefore, key things to look at here are your margins. One is your gross margin, which is basically the sales that you're making and the direct costs that are involved in you making that sale. That difference, is it giving you a positive or is it a negative? Or if it's giving you a positive, does that positive support further costs, operational costs that we are going to see in the business or not? And then your net profit margin, which is basically saying, after I've considered all the costs of the business, both the direct costs involved in me making a sale or delivering a service, or the operational costs in me running the day-to-day aspects of my business. If I add those together, does it give me headroom at the end, or it doesn't give me headroom at the end? Now, analyzing this is very, very important as part of finance strategy, especially when you want to ensure that your business remains sustainable in the medium term and the long term. The second is around pricing. Now, I've seen businesses where, especially trading businesses, whereby I purchase an item that I'm going to sell onwards, and then the only thing I do is I multiply by 2 the cost at which I've purchased it, and then that's the selling price at which I'm going to sell it. I do not get into the details to understand the price that I have set, first of all. Does it cover my cost? For someone who just doubles would say yes. Does it cover my cost at which I purchased the item? Does it cover my operating costs? But also, does it give me a healthy headroom that I can maintain money in my pocket, in my business? Now, also, if I just multiply by 2, do I assess the environment to say, okay, am I pricing optimally? So if I have competition, am I pricing either above competition or am I pricing way below the competition? And therefore, this pricing has an impact on the final bottom line of the business, which is profitability. And it's something that is important to interrogate for any business. Now, when it comes to cost reduction, we've seen what we call lean, either for those that are in manufacturing, lean manufacturing. We've seen what we call Six Sigma, and there are many methodologies that do apply. But also we've seen businesses that just reduce cost for the sake of cutting it, but don't reduce it in such a way to make it as a strategic lever for either business performance or growth. And what do I mean? You need to identify what your key competitive advantages are as a business or as an entrepreneur, whatever business that you're running. And then wherever you're going to spend your money has to be aligned to those competitive strategies. It's very, very important. And then that's how you will derive your strategy for cost reduction. To say, I'm going to remove money, say from day-to-day expenses, either I'm renting highly a premise or from transportation, and I'm going to invest that money in, say, digital marketing. I'm going to invest that money in say upskilling my team. I'm going to invest that money in innovation. Why you do that is because you're aligning your costs or your expenses to where you have competitive advantage to ultimately achieve your strategic objective. And that's part of what we call cost reduction, but in a strategic way. And then the other is basically around profitability, is to do your day-to-day checks of performance reviews. How often do you do them? How often do you do those checkpoints within your business so that you identify that I'm on the right track or I'm not on the right track, or this is where I'm on the right track. Again, having those regular performance reviews, and again, also comparing yourself to the industry or your competition is very important. It's also part of finance strategy. Then the last aspect of it is around risk management. Now, we have seen our operating environment be volatile. We are operating in a time where we've seen actually the US dollar or the Ugandan shilling perform well against the US dollar. Now, that works well for those that seek to import or purchase goods in foreign currency, but then can be a downturn for those that actually incurring or charging in foreign currency and then incurring their costs in local currency. So managing that risk becomes very, very important. The other aspect is for those who have customers whom you've given credit. Have you assessed their ability to repay? Have you assessed their cash flow levels? Have you assessed the extent to which you've leveraged to them? Or have you optimally extended that credit to them? How do you manage that? These are aspects of risk management that are important in finance. And the other is just basically your day-to-day risk. How are you managing fraud in terms of the way your business processes are set up? How are you managing efficiency? We see most customers getting frustrated or you failing to make a sale because your operational efficiency is not good. So how are you able to assess these risks in terms of identifying them? Because all businesses have what we call inherent risks. You have risks already in the business, but have you identified them? Have you assessed their level of impact on your business? Do they slow down your business processes? Do they actually incur costs to you? Are they actually showstoppers? And then are you able to come up with initiatives or mitigation strategies to reduce these risks actually emanating or crystallizing? So how are you able to do that entire assessment? Because ultimately these risks will prevent you from achieving your overall business objectives. And that's why it's very, very important. And now, how does this strategic finance leader come in? Now, one of the key things is to identify the impact of these businesses or these risks, on your businesses. And we do it in several ways. One is to do a sensitivity analysis. Sensitivity analysis basically saying is to create different scenarios. To say, for example, if the exchange rate reduced, say, to 4,000, also reduced to 3,000, or if it increased to 4,000 shillings, how does that impact my overall business in terms of pricing, in terms of my costs, in terms of my profitability, in terms of my expenses? You can also do a sensitivity analysis regarding your sales. If we are in a political environment, for example, now where people are campaigning, we know that there are very many disruptions. So when I look at historically what that impact has been in terms of my sales or what people are saying will be the disruption, and I apply that to my sales, because probably my movement for my sales team might be inhibited, or actually it might create more people in an area because we have an influx of people coming into an area to support a particular candidate. When I do those sensitivities, how does it impact my business? It could be that you've borrowed money from a bank, and we do see that these exchange rates do actually fluctuate. Are you able to preempt that impact on your business? That, for example, if the central bank changed the central bank rate, and therefore my banker decided to increase my rate, say from 16% to 19%, what does that increase in interest? How does it impact my business and my cost? Because remember, that is going to impact you both on the profitability perspective and also on the cash flow perspective, because you're going to have to pay out interest. to the bank, but probably you're paying off more of the interest than the principal. And therefore, how long is it going to take you to repay your debt? So these analyses are very, very important for you so that you create interventions or you prepare yourself for these scenarios when they do occur so that the business does not get hit abruptly. The other is insurance. Now, one of the key things that insurers do is they actually do risk assessments for many businesses. But sometimes, probably we may not want to take up this because probably it may not be offered for free. But sometimes they do these, risk assessments so that then they are able to tailor the correct insurance package for your business. Now, sometimes we do fear to take out insurance because most times we feel that probably we are paying out a premium on an annual basis that we might never get to utilize. But the interesting thing about risk is that we never know when it will occur. Okay? And remember, also, you have it inherently, but probably it has not magnified itself to the extent to create a current impact in your business. And therefore, insurance is a good strategy to take out, be it against your stock that you have, be it against some decisions that you will make in your business as a director, be it against fraud, be it against the assets that you have, so that at any one time when that risk emanates or materializes, then you don't have a large outflow of cash to bring your business back to the operational levels that you need, but you're actually adequately covered by that. Then the other is what we call hedging instruments. And basically, hedging instruments, to simplify it, is basically saying that probably I do envisage that either the contract of my price is going to be reviewed in the near term because its contract is pegged, say, on a particular index. For example, those that might be dealing in fuel, or those that might be dealing in commodities like coffee, or those that actually do export or import items. Like, for example, now where we are in a low exchange rate environment, you might anticipate that probably this rate might increase as we close the year, or actually might reduce further as we close the year. Now, that change might actually impact on you if you're exporting, that the price at which you're going to get the price that you're going to get for your goods might be lower than what you anticipate, or for those that you're importing, that you're going to have to pay out more than what you would ideally have paid. And therefore, you're able to approach some of your bankers to say, okay, can I get some of these hedging instruments in terms of either forward contracts or in terms of options and swaps and all these? I know the language is it's a flavorful language, swaps, options, and all, but these instruments just basically help us safeguard against any volatility in terms of movement so that your business is able to maintain a certain level of volatility or a certain level of performance as you move on in the medium term to long term. The other bit around actually also managing risk is diversifying. You might probably be dealing in one line of business or one set of products, but it would be good also as a hedging strategy to say, I can then open up different streams of revenue so that I'm not impacted in case this particular product does not sell. And we've seen that very well or very much with companies that deal in either the telephone industry, the phones. We've seen it with manufacturing companies that do increase their portfolios and so on and so forth. And one of the key things or contributors that a strategic finance leader does is to build this culture, this risk-aware culture within the organization. Because as he does all these sensitivities or as he preempts some of these risks, then you're becoming aware of the risks that might emanate or the challenges that may emanate in your business. But most importantly, you're setting safeguards that will help your business remain operational in the medium term to long term. Then the final one, which is the investment strategy, is to decide once you've obtained the capital, where am I going to deploy it? Am I just going to buy land and I don't know whether I'm able to get a return from there? Am I just going to buy a car that is going to depreciate today, tomorrow? Or I'm actually going to buy a car that will be able to do certain routes that will be able to deliver me more sales than the man who's using a border or than the man that is riding? Or am I going to invest in a software that is going to make me more efficient in terms of delivering my service to a customer, or I'm not. So investment strategy is also very, very important. And where does the strategic leader come in here? Is to determine the return. What return am I going to get when I make this particular investment? Okay, am I able to assess so that I'm able to give you or give an opportunity for you to make a decision knowing what that return is going to be when you make that investment? Also, how am I able to balance? Now, we have seen people who look at short-term gains and say, for example, I'm going to invest here because I can see the money coming quickly, or I'm actually going to deploy it in a project that I may not realize a return in the next 3 years, but from the fourth year and onwards, the returns are going to come that actually will give me a payback period that's less than 5 years. So again, the ability to balance short-term gains and long-term value creation is something that a financial strategic leader does. Then aspect also of aligning your resources to your overall objectives or your overall strategy objectives as a company is very, very important. I might get money and I get excited and say I want to buy a car. I might get money and I get excited and I want to buy a machine. But then I haven't gone back to say, okay, does this purchase align to what I laid out as a business on the things that I would want to achieve? And therefore, creating that discipline is one of the things that this person does to ensure that we remain aligned on the overall objectives of the business. Then the last one is that I've purchased the asset, I've purchased the land, I've purchased the vehicle. Is it actually giving me the returns that I thought at the start before I invested it would give me? And therefore, the aspect of monitoring these projects, monitoring these assets, that they're deriving value for you is also another thing that is important when it comes to deriving your investing strategy. And setting benchmarks that you would want to see. So if I am to invest $1 or 1 shilling, probably my expectation is that for every $1 shilling that I invest, I should be able to get 3 shillings or $4 out of it. And therefore, that investment strategy is very important. Now, putting all this together, I've mentioned the different pillars of finance strategy. The ultimate is to ensure that all these strategies align to the overall business objective. And how do we do this? One of the key things is a finance person is not a person who sits in the corner and just counts the bins and gives you the number. It's the person who should be able to work with you in your business and actually highlight that this is what we set out to achieve. So these are the key performance indicators we are looking at, and this is how we are performing against it. If you operate a big business, he's able to say HR, marketing, sales, finance, can we come together and ensure that we are all aligned? Whatever we're executing, whatever we're doing is actually aligned to the overall objective that we want to achieve. Be it from a financial perspective that we've set returns that we want to get, be it from a customer perspective in terms of the number of customers we would want to attract, be it in terms of how the organization is operating efficiently, or if it's terms even of the people that we have the right caliber of people, are they motivated to deliver on the business that we want them to deliver on? So maintaining that balance, this person is able to bring all these together and cross-collaborate across functions to ensure that we all remain on the same track of achieving the objective. Now, I've actually highlighted the roles of a strategic finance leader. And just to summarize for me, is the aspect that a modern strategic finance leader, whom we call a CFO, is no longer just a custodian of the numbers. They are persons who are able to work with you with your strategy. They're the ones that are able to steward your risk to ensure that the business is able to cushion or absorb these risks once they emanate. They're able to drive performance of your business to ensure that at any one time, you're being abreast with how the business is performing. If it's not performing well, what are those mitigations that we are putting in place? If it's performing well, how can we maintain that same performance? But also to transform the organization. We are living in a time where there's a lot of disruption. An idea you might have today, by the end of the week, might actually be surpassed by something new that will come up. We're living in a time of artificial intelligence. You can be able to set up things so quickly. So how are you able to position your business in such a way that it does not remain buoyant, but it's able to remain growing and able to transform as your business environment changes? And that's what this person is able to bring on board. Now, In the market, we have seen people provide accounting services, and we have seen people who do provide this. And I know there's a name that keeps coming home, fractional CFO and all. And I just wanted to highlight how we can actually access some of these CFO advisory services. I do run a company called Impension that actually provides, this is part of the services that it does provide. And we run basically on a 3D framework, which is basically we come into your business and diagnose, understand what are the actual realities of the business. Yes, you're seeing money coming in, but is your business profitable? Are you liquid enough? Are there risks that you have not factored in? Are you performing as expected? Very, very important. The second now, based on your business, is to decide something that is tailored to the size of your business, to the aspirations that you want to achieve, to the nature of complexity that you have, so that you are able to design solutions for that for you, and then ultimately deliver something that is going to see your business transform, but also remain sustainable in the long run. Then we do offer packages across, depending on the size of your business. We have the essentials packages, which is basically for a startup or SMEs, basically around stabilizing, doing a diagnostic and showing you what the quick wins are. We do offer a growth package, which has been very popular with us now, where we are seeing companies that are seeking to scale. And therefore, we focus on strategy and performance management for these. And then we also have those that would want to actually transform, whether we actually do end-to-end CFO advisory, as I've mentioned to you there. And Anita, that is it from me. I hope I haven't taken so long, and I hope I've been able to do justice to the topic that's before us. Thank you, and I hand it back to you.
Wow, wow, wow. Thank you so much, Andrew. That has been very, very educational. It has been informative. I've been scribbling things here on my I'm just trying to look at my notes here. Thank you for taking us through the core pillars of financial strategy. I think this class was for me. I don't know about the entrepreneurs on call, but please go to the chat and give Andrew a hand clap. These core pillars of financial strategy, the capital structure, the budgeting strategies, the cash flow management, the profitability and cost control. Wow, thank you so much, Andrew. You've given us a lot to think about, indeed, from the different pillars that you've carefully gone through all, during your presentation. And now I think I just want to get into the Q&A session and just listening from what entrepreneurs have. Of course, I personally also have some questions, but I'm sure some of the entrepreneurs will raise these questions. Thank you. Let me just go to the chat and see what the entrepreneur is saying, but feel free to shoot up your hand if you have a question. Yes, Martin says this is grateful. Thanks a lot. Robert says, thank you, Andrew. It was awesome. And Anne says, thanks, Andrew. Great presentation. Remember, entrepreneurs, these sessions, you can access them via YouTube. If you registered for this session, you'll definitely get a YouTube link so that you listen to this session again. These kinds of sessions are not sessions you listen to once and go, now, Andrew, if entrepreneurs want to access you, it may not be as easy, although you've shared with us your packages. You've not mentioned the price because I think I need you in one of those packages immediately, of course, for my personal business. Yes, but thank you so much for that presentation. You let us know the cost of those packages when you come back to speak. Yeah, Ronald says thank you. That was very insightful. Joan says, thank you. You've boosted my understanding. I think I share the same feeling with Joan. Margaret says, thank you. It was so comprehensive and educative. Okay. Ladies and gentlemen, dear entrepreneurs, we are waiting for the questions. Andrew is here, and we want to, of course, see how to also wind up this session so that you can get back to your work. But in here, trying to look, Robina says, thank you so much, Andrew, lots to learn, especially on financial discipline. It's very easy to drown a business in owner drawings. can you advise on which systems are good to help us track record for small businesses? There you are, Andrew. That's your first question. Apollo says this was epic. Thank you. Okay. Isaac says, thank you for the presentation. Kindly highlight the key components of a good risk report. There you go for your second question, Andrew. I'll just bring in the third one and we see how you can take those up. Joseph says, thank you so much. That was a great presentation. Andrew really ripped it. There you go. He did. Rosemary says, thank you, Andrew. Please expound on what an SME should do to ensure liquidity when the costs remain high due to small nature of their business. Okay, now I just want to stop there. I don't see any hands raised, but I'm hoping that after Andrew has responded to these three questions, we'll give an opportunity to some of the entrepreneurs to raise their questions. Andrew, please, the floor is yours.
Thank you very much, Anita. And again, it's a pleasure being here. I'll start with the first question, systems that are good to track businesses for small entities. There are several several systems that are available. And actually, we also do offer that advisory service. So you do have QuickBooks. I'll start with the simple one, QuickBooks, which is actually very, very good, especially the one that is online, because you can access that performance anywhere. It's flexible in such a way that you can also add any number of people that you want to access that information. And it's actually very cost-friendly when you look at what you need to pay. There's Zoho, and there are several others. What I suggest, again, you can reach out. My email is available, and we can advise, again, based on the nature of business that you're doing, we can advise what you can use. There are even tailored solutions, can be through Excel, can also be through Google Sheets that we can use, again, depending on the size of the business and what you want to do. But I highly recommend all entrepreneurs that you ensure that your businesses actually have a system that's tracking your business activity. The second one, the second question was around what are the key components of a good risk report. Now, risk assessment, first of all, is to understand, before we get even to a good risk report, is to understand whether you have actually a risk management policy or an enterprise risk management strategy for your business. And then that forms what the business or what the shareholders or what the board or what management focuses on. And one is basically to highlight what are your principal risks and what is your risk appetite for the business. Now, a good risk report needs to bring those out very clearly. First of all, to understand the direction of those principal risks that are within your business and any emerging risks that you've highlighted that are important. And by direction, I mean that you've actually assessed each risk and understood whether in your business it is growing or it has been maintained or it's actually decreasing based on the interventions that you're doing. Secondly, is an assessment of whether those risks, again, when you're doing that risk, whether it's within your risk appetite. Is it within your risk appetite as a business? Probably you've taken on a client or customer, or you've extended credit. That may not be within your risk appetite. So again, having an assessment of how these risks are flowing within your risk appetite are very important. The third bit is around your intervention. What interventions have you either deployed or you're yet to deploy, and by when, and who's going to manage them? And lastly is to have an overall rating of your business from a risk perspective. We have what we call a risk index. And again, like I said, depending on your policy, then you do highlight what are things that are core, are important to you. And when you accumulate it, what is your risk index? Now that risk index will inform whether your business environment is actually heightened in terms of risk, and therefore you need to address it very quickly, or it's medium, moderate, or low. So those are the key elements that actually form a good risk report. The other one was specific. The other question was, how can I expound more on what an SME needs to do to ensure that they remain liquid in an environment where they're incurring many costs? I hope I got that very clearly. The first thing you need to understand, like I said, is to look at your cash flow. Liquidity is cash flow. What money is coming in, what money is going out. For example, you will find that probably the sales team, or you're not selling as much as expected, or the environment has changed, that what you're selling is not going out as expected. So the money that is coming in is less. Whereas then you have a major cost base that you need to deal with, because you have costs which are sunk, that whether the business operates or not, those costs have to be paid, the likes of rent, the likes of salaries, the likes of your internet connection, and all so on and so forth. Then you have those costs that vary with the sales that you make. And therefore, the first thing is to do that analysis to understand, why is my business not performing as expected? Have I extended myself so much that probably I'm operating more locations than I ought to be, or I've taken on more customers than I ought to be? So that assessment has to be done to pinpoint exactly what is causing your hemorrhage in terms of your cash flow. Why is your cash flow negative as opposed to positive? Then based on that, what I would advise again is to come back to the other aspect of, what are my core strategic priorities? When I look at this assessment, have they changed? So where I'm spending my money, is it still aligned to those core priorities? Or do I need to come back and change these core priorities? Probably I thought I would extend my business to Gulu, I'll extend my business to DRC, I'll expand my business to Kenya, which I no longer need to do. And therefore I need to cut back on that. So again, it's to come back to, what were your core strategic priorities? Do an analysis of what's coming in and going out and what's causing that. And then you can make a decision based on that. Thank you, Anita. Back to you.
Thank you so much, Andrew. Yes, I think those that asked the questions, you put in your answers. Please feel free to ask for elaborations if the point doesn't come out clearly. But from my end, I feel Andrew is really helping us understand this in the simplest way possible. Andrew Mohsin here is asking, do you offer anti-money laundering risk assessment for enterprises? That one is your fourth question. And then Ahmed says, what is the recommended debt equity ratio for SMEs? Okay, so you can take note of that one too. Okoth says, I need a refresher with QuickBooks and Tally. Reachable, and he shares his email. I think what you will do, of course, is to reach out to Andrew. He will share his email in the chat so that you can have a conversation with him in regards to your refresher training session. Andrew here says, if an SME is at startup level, as a CFO strategist, what is your opinion on engaging in non-cash investments? For example, opting to engage insurance providers who do not actually pay cash, but when they do, they actually pay well. Is it worth the risk? There you go. Then lastly, we'll have Isaac, and then we'll bring you back, Andrew, to just respond to this. Isaac says, thanks for the presentation. Please elaborate on how to come up with a good pricing strategy that will be competitive and yet profitable. So Andrew, I'm going to bring you back there. We'll respond to this, and in case there are no questions, we'll just see how to wrap up this session. Over to you, Andrew.
Thank you very much, Anita. And again, thank you for the questions on those who are on the call. Do I offer anti-money laundering risk assessment? No, I don't. I don't get there, but I can highlight those risks when I do the risk assessment. But again, I can also help the business identify someone who can do that in detail and in depth. However, I will highlight that, again, when you do an overall risk assessment, at a level you are able to tell whether the business actually is exposed to anti-money laundering or not, but I don't do it to the depth of that. Then the recommended debt to equity ratio for an SME, usually the recommendation is north of 60 to 70%. That's debt to equity. That means you need to have more debt than equity. But most times for startups or SMEs, the challenge you usually face is the ability of the bank to trust you, or the ability or the size of collateral that you're willing to offer. And therefore, sometimes when they're doing your credit worthiness, one of the key assessments that they do is to check what level of investment has the shareholder made in the business, or what amount of collateral assets is available. And therefore, most times you'll find that they may not extend to you as much debt as required. But the key way to build that, and you can build that very quickly, is to ensure that you keep your records, or you keep cash flowing through the accounts. And I've done this several for many businesses. You will find that actually the bank can actually give you a facility of the nature of activity that is on your account. Now, it's very, very important. I know for some businesses, some transactions, they may not want for them to flow through the account, but that's what you miss out on, because actually you can get a collateral of the volume of activity on your account, as opposed to either giving a title or giving another asset that you might be of value and you wouldn't want to extend it to the bank. But it should be north of 60 to 70% in terms of the debt to equity ratio. Then the last one was not so clear, Annette, but maybe to understand, engaging in non-cash investments like insurance for a startup or an SME that is less than a year. Now, again, what is important is to understand the business environment in which you operate. I'm taking it from the aspect of using insurance as a risk limiter, if that's my understanding, or if you're actually saying, I have cash and I would want to invest in, say, for example, like insurance bonds and the like. So I'm a bit lost there in terms of, is it for an expense of the business, or is actually a cash investment in terms of anticipating a return from an insurance provider? And I'll try to respond to both. So if it's the first one, which is as an investment in, say, insurance bonds and all, for you to make a return, again, it comes back to what was the overarching objective of your business, and to where do you stand from a liquidity point of view. Insurance bonds usually have tenors, or insurance policies have tenors, and usually hold up this money for a long period of time. Now, when you're dealing with SMEs or startups, usually cash is king, and we have what we usually track, what you call the cash burn rate. How much are you expending cash? Because there are always things that pop up, because you've not yet stabilized the operations of the business. And therefore, I wouldn't advise to, say, invest in such long-term, say, investments or bonds, because your ability to liquidate them quickly and obtain cash might come to your detriment, because most of those insurance policies, if you don't see it, say, close to 2, if you don't pass the second year, third year, either you don't get your initial investment, or you'll actually get less because of the costs of you canceling that particular policy. So you need to invest in assets that actually you're able to liquidate quickly and are able to give you or make that money available for you so that you can use in your day-to-day operations. So that's how I would address it. Then if it's from an expense perspective in terms of safeguarding the business, again, it depends on the level of liquidity that you have for you to deploy. But again, also the operating environment. Is it a high-risk environment or not? But taking out an insurance policy is usually good, because then for that risk that you may not foresee, or that might emanate when you're not aware, it helps prevent significant disruptions in your business. Thank you.
Thank you so much, Andrew. And ladies and gentlemen, if I were you, again, we'll be clapping. Thank you, those who are clapping in the chat. Thank you, Andrew, for being quite elaborate on that. Now, one of the things I'm seeing in the chat is a plea for a refresher. Please, Andrew, I'm going to request you to share your email in the chat so that the entrepreneurs can pick on it, so that they can be able to reach out to you. And ladies and gentlemen, since I don't see any hands raised, I'm going to invite Andrew after he has shared his email in the chat. Yes, you missed out a question on pricing strategy before I invite you to give your parting shots. Someone had asked the question on pricing strategy. I think we missed that. This was Isaac who said, please elaborate on how to come up with a good pricing strategy that will be competitive and yet profitable. Yeah.
All right. Thank you, Anita. So pricing strategies evolve depending again on the nature of business that you're operating, the nature of competition and all. We have those that actually do look at what their costs are, what we call the cost plus. You look at the cost that you're incurring as a business. And then after you've accounted for the cost, then you put a markup and then you're able to price. Then we look at those where you work backwards, where you look at what is the prevailing pricing in the market. And then if I work from that price backwards, then I'll be able to account for my costs and also account for any margin. Then I'll know what to touch to ensure that I remain profitable. And that works a lot. The cost plus works a lot in the manufacturing business. And then the market pricing works a lot, especially for services, but also in actually services, because the airline business is actually a service-driven business. So the key thing for you to come up with an effective pricing strategy is to know your cost base. Know your cost base is very, very important. And again, for you to know your cost base, that means you need to be actually taking record of all transactions of your business. Because sometimes we might say remove or exclude costs that are actually important in terms of you understanding what your cost is. Then second, to know the capacity of your business. So how many products are you able to churn out so that you get the unit cost and then you're able to price effectively. And then the other is to do your market research. What is your competition pricing? And therefore, when you bring back these prices and then you're doing your analysis, are you pricing yourself above or you're pricing below? Most times, actually, we don't do market research. At least from my experience, what I've seen, we don't actually do effective market research to understand. Then the other bit is also to understand which clientele are you serving, because again, there are segments. You may not price segments the same. You might find that a retail customer will be priced different from a wholesale customer, will be priced different from a premium customer, that one who considers service above the good, or who considers customer service or experience, actually, either the experience with the good or the experience with the service. So again, it's for you to also understand what segment am I serving? Who are the competition? Who are the competitors in that segment? What is my cost base? Then that enables you to have to properly price. Then the other bit, the last one that I would also just add on to that is your budgeting or your planning. What did you plan to achieve? Because whatever you plan to achieve also comes off a factor of your quantities that you plan to sell and the price, or the service that you plan to render and the pricing. So again, you bring that back into the foray, and then you do that analysis so that you come up with an effective pricing strategy. But also, again, depends on the maturity of the business. So are you just a startup trying to penetrate a new business environment? Have you been in the business for a long time, and therefore you're effectively able to understand the dynamics and all? So again, it also depends on the maturity. So there are various factors that you need to consider, again, depending on the environment, the maturity of the business, the level of competition, but most importantly is for you to understand your cost base.
Yeah, there you go, Andrew. I hope you've gotten your questions well answered. Thank you so much, Andrew. Martin, okay, do we take this as the last question? Martin says, is it advisable to utilize unit trusts in managing cash flows in business? Andrew, that one you can answer in 1 minute. Yeah.
Yes, I mean, we've seen unit trusts evolve. I mean, you can be able to withdraw your cash within 2 days, 1 day, again, depending on the need. So any investment, the thing you need to consider is, one, what stage of the business are you in terms of maturity? And then also, what are you seeking to get? Because the unit trust will help you to get some level of interest in the short term for probably a purchase that you need to make in 3 months or so. So you're able to do that. So the ability to liquidate that quickly has now become very simple, because you can liquidate it in a short space as short as 2 days. And I think they do not charge a significant liquidation fee, because I've seen some that are actually free. So actually, it's okay to put your money in unit trust. Yeah.
There you go, Martin. You can actually manage your cash flows through unit trusts. one of the beneficiaries of unit trusts, and their services are just amazing. So thank you. Andrew, I'm going to invite you to give your parting shots. What are those last words to the entrepreneurs this morning in regards to strategic financial leadership?
Yeah, my parting shots are I think for me, focus on one thing. You set up that business to achieve a particular objective, and not just to set it up, achieve it, and close. To achieve something that's sustainable, not to benefit only you, but to those around you as well. So I do call upon you to take up these financial strategies, align your businesses so that they remain sustainable in the long term. Thank you, Anita, and thank you, entrepreneurs, for having me.
Thank you so much, Andrew. Dear entrepreneurs, there you've heard it. Please let's give another hand clap to Andrew. He has discussed well. Thank you so much. That was a rich and very practical discussion. Andrew, you've clearly shown us that financial strategy is not just about managing numbers, but about leading growth, building resilience, and really positioning our businesses for the future, and especially for our Ugandan businesses to rise and compete globally. We must think beyond survival. Many of our businesses in Uganda really, for as long as we survive, we're good to go. But I think this presentation is one that we need to continually have, or even just feed on as entrepreneurs. And again, Andrew, those packages you shared, please, I think people should reach out and find out what's the cost, how can you help, in helping them align and streamline their financials so that you can start leading with strategic financial discipline. And so to all our participants, I hope you're walking away with fresh insights on how to apply strategic financial thinking in your enterprises, whether that means improving your budgeting, strengthening your cash flows, or rethinking your entire capital structure. We believe you're walking away with fresh, and helpful information. And as we've heard, every growing business truly needs a strong financial leadership. Let's be intentional about building that capacity within our teams and within our businesses. Let departments not fight, thinking maybe one department is, interacting with my operations. But no, we need to align all these for the good of the enterprises. And so on behalf of Enterprise Uganda and the Global Entrepreneurship Network, we want to thank you for being a part of today's Business Recovery Series. And a special thank you once again to our guest speaker, Mr. Andrew Ssekamwa, for sharing his time and expertise. Thank you. We really do appreciate. We encourage you to stay connected. We have this series every Thursday from 9 a.m. We try as much as possible to end by 10:30. Stay connected, keep learning, and join us for the next session in the series that we shall communicate, so that we can be the generation of entrepreneurs who don't just build businesses, but build financially strong and sustainable legacies. So I want to thank you all for joining. Please do find time and visit us at our offices in Butavika. And I want to wish you all a productive day.